Geopolitics and artificial intelligence are shaping the new market normal. Business planners need to be alert to the new realities and have strategies to proactively build resilience and exploit the new opportunities. As we move into the year's second quarter, geopolitics has shifted from a background influence to a major force directly shaping markets and business decisions. Investors paid less attention to the IMF's April 2026 World Economic Outlook, which noted the global economy now operating in the shadow of war, forecasting slower growth at 3.1% for 2026 and rising inflation. But markets reacted immediately when news broke of a possible truce between Iran and the US at the Strait of Hormuz. This announcement sent crude oil prices tumbling by over 10% and instantly boosted positive sentiment on Wall Street. The IMF and the World Bank announced pledges up to about $150 billion in new financing assistance for developing countries hit hardest by the massive energy price shock, while celebrating their re-engagement with Venezuela's acting government after a 7-year pause. Still, it remains unclear if developing countries are making enough progress in building structural resilience and buffers to defend against shocks which appear not to be abating. The geopolitical conflict has severely disrupted regional energy flows, with physical crude benchmarks surging far above future prices, signaling a situation where the market is struggling to price the true scale of supply disruption. Central banks are trying their best to present a calm face amid dangerous but familiar stagflationary forces. The US Fed can no more ignore rising costs impacting sectors such as fertilizers, aviation, and even groceries. Fed doves like Governor Stephen Miran are now considering how many rate cuts to expect in the year, if there is any, as the Fed is cautious for longer. The European Central Bank had seen inflation returning to target before the shock arrived and is now compelled to conclude if the rise in oil prices remains temporary or will have a permanent scarring impact on prices. All the ambiguity also plays to favor high gold prices as the yellow metal regains its value as a hedge against policy uncertainty. Investors are responding to current market conditions by exercising increased discipline as the present fragility of the markets poses significant challenges. It is essential for them to remain attentive to macroeconomic indicators and emerging vulnerabilities, necessitating a reassessment of previous assumptions. We may be entering a new, different era of market conditions marked by ongoing geopolitical disruptions, weakened progress against inflation, and limited flexibility from central banks. In this environment, discipline becomes more important than optimism due to uncertainties from conflict and complex macroeconomics. These circumstances call for well diversified portfolios that are better defended. Gold continues to serve as a safeguard amid uncertainty. Meanwhile, assets like cryptocurrency remain volatile even though they attract some attention from those wary of institutions. A recent CNBC survey of policymakers found that they must prepare for less favorable scenarios, such as stagflation. Nations are being strongly encouraged to diversify their energy supply chains, increasing the use of nuclear and renewable sources. Markets have remained resilient, maintaining momentum despite concerns related to impending conflict. The effects of changes in supply chain dynamics on sentiment are difficult to gauge, especially as restrictions at the Strait of Hormuz ease amid what appears to be a very fragile truce. Consensus has emerged around radically questioning old market and data assumptions and cautiously responding in the very dynamic and different context. Hello, this is Global Business Insights, where we look at the world from a business perspective and bring analysis and updates that help to navigate the context. After Iran said it had opened up the Strait of Hormuz, Trump stated the U.S. naval blockade will remain until a peace deal, causing oil prices to fall 9%. Iran's parliament speaker then warned the strait won't remain open with the blockade in place, increasing uncertainty. Oil tankers were reported to have come under fire. But in a developing situation, the US yesterday seized an Iranian-flagged cargo ship trying to get past its blockade of Iran's ports. The US Navy blew a hole in the engine room and took the ship into US custody. Iran has reacted by vowing to avenge the seizure and has refused to confirm participation in further peace talks planned for this week. Crude oil prices and early morning trade resumed an ascent back towards $100 Brent in response to the renewed tensions. Trump had said his representatives would be in Pakistan today for negotiations, with the U.S. delegation led by Vice President J.D. Vance. Unclear where that now stands. Across the globe, economies are adapting to new challenges. This week, the European Commission is expected to introduce a range of initiatives aimed at addressing high energy prices. These include reducing demand, boosting energy efficiency, and supporting the transition to clean energy sources. The steps will offer immediate relief on high energy prices and will promote concepts like remote work. These recommendations draw on strategies employed during the previous energy crisis following Russia's invasion of Ukraine. They are designed to reduce dependence on fossil fuels and promote the adoption of green energy. Where feasible, businesses may be encouraged to implement at least one mandatory remote working day. Measures to be announced will include subsidizing public transport and lowering VAT on heat pumps, boilers, and solar panels, and more ambitious targets for electrification. Brussels will support member states in establishing social leasing programs for clean and efficient technologies such as heat pumps, electric vehicles, and small-scale batteries. The rise of artificial intelligence is reshaping the workforce, reducing entry-level jobs and leading more graduates to pursue further education. A recent Janzaba SPAC 451 survey found that nearly 78% of prospective graduate students plan to enroll within a year, up from 69% last year. That's enrolling for further graduate education, postgraduate education. Graduate school enrollment often rises during economic downturns as workers aim to improve their skills or shift into fields offering better pay or advancement. AI also remains a hot topic as finance ministers, central bankers, and financial leaders voice concerns about Claude Mythos, a powerful new artificial intelligence model developed by Anthropic. They worry it might threaten the security of financial systems. These emerging technologies introduce numerous unknown risks, making them important for all stakeholders to address seriously. CEO Barclays, C.S. Venkatakrishnan, commented that this is the new world, a globe with much more connected financial systems, with both opportunities and vulnerabilities. Bank of England Governor Andrew Bailey is closely monitoring AI developments for potential cybercrime threats as malicious actors are positioned to exploit vulnerabilities. The US Treasury also advised banks to test their systems and ensure safeguards before Mythos by Anthropic is publicly released. Experts say Mythos is just the first in a series of powerful models that can reveal and potentially fix system weaknesses, prompting regulators and central banks to take proactive measures to protect the financial ecosystem. Indeed, the AI momentum and impact no way abating. But what of emerging and developing economies? These are likely to be impacted by rising global risk aversion, prompting increased capital outflows from southern economies and flight to safety outweighing pursuit of returns. Still, on emerging economies, South Africa's Flysafair has said it cannot afford to operate routes with weaker passenger demand amid soaring prices. It cut its Lanseria Kugompo City route as it continues to review its network and adjust according to demand patterns and the prevailing economics. According to data from the International Air Transport Association, jet fuel costs neared $198 per barrel in April, nearly double the $99 per barrel cost before the US-Iran conflict began. Central bank leaders in Africa have also been paying attention. South African Reserve Bank Governor Lesetja Kganyago says it is difficult to see a near-term path for easing interest rates due to the volatility from the war in the Middle East and impact on inflation. He added that the Apex Bank would not update its inflation or growth forecasts between meetings and is leaning on scenarios to help it understand the impact of wildly gyrating prices for commodities, including fuel and fertilizers. And in Nigeria, speaking on the sidelines of the IMF World Bank spring meetings, the central bank governor, Yemi Cardoso, says the impact of the Middle East crisis on the Nigerian will not slow Nigeria's push for resilience and a single-digit inflation target. He also defended the Monetary Policy Committee's decision to maintain a cautious, data-driven stance on interest rates despite some pressure to ease policy. The Minister of Finance and Coordinating Minister of the Economy, Mr. Wale Edun, also said Nigeria's reform agenda was now being seen as credible, durable, and self-sustaining, adding that Nigeria is positioned to withstand external shocks while attracting stronger investor confidence. Still on the impact of the geopolitical turmoil, Nigeria's aviation minister is asking local airlines to avoid suspending flights or raising fares after carriers threatened to halt operations over a sharp rise in jet fuel prices. The minister acknowledged the pressure on airlines from the soaring cost of jet fuel, adding that an emergency meeting with regulators and stakeholders in Abuja on the 22nd of April has been scheduled to find a prompt and sustainable solution. As we see expensive petrol accelerating a transition to non-fossil fuels and electrification of vehicles, demand for lithium used in batteries is likely to be on the rise. An Australian mining company, Chariot Resources Limited, is reported to have been granted permission to mine lithium in Nigeria after regulators approved 6 licenses for its operations. The licenses include 4 exploration permits and 2 small-scale mining licenses previously held by Continental Lithium Limited. To other stories, it's not all doom and gloom. Egyptian property developer Talat Mustafa Group wants to build a $27 billion new city on the outskirts of Cairo. The city will involve 165 residential, business, and commercial towers, according to the CEO Hisham Talat Mustafa, and is the latest mega project in a country that has attracted tens of billions of dollars in Gulf investments for lavish coastal communities. The shortage of housing in emerging economies, especially in Africa, is a major market opportunity expected to be targeted by investors. Interesting times as opportunities still abound. Asia-Pacific markets were mostly higher as investors cautiously observed renewed tensions in the Middle East. Today, China held benchmark lending rates constant for an 11th straight month amid escalating Middle East tensions. The decision came also as it reported 5% GDP growth in the first quarter, accelerating from 4.5% in the previous quarter. Well, that's it on this special edition of Global Business Insights. This is Bode Oshosami. Do not forget to subscribe and hit the notification button. Bye-bye.